Convert money to a Roth IRA this year, Medicare might send you a bill for it. Not this year, 2 years from now. And it could cost you over $10,000. Let me show you exactly how this trap works and how to avoid it. Here's a number almost nobody expects to see on a Medicare bill. $689.90 per month for one person. That's not a scam. It's called IRMAA, the Income-Related Monthly Adjustment Amount. And in 2026, it can quietly add anywhere from $95 to almost $500 a month to your Medicare bill. The strange part? It's not based on what you earn today. It's based on what you earned 2 years ago. So a decision you made back in 2024 could already be sitting in your mailbox right now, in 2026. Everyone starts at the same place. The base premium for Part B is $202.90 a month. But cross an income line from your 2024 tax return, even by $1, and you don't just pay a little more. You jump straight into an entirely new tier for the whole year. Take a look at this table. 6 tiers, from the bottom all the way to the top. At the bottom tier, there's nothing extra to pay. But at the very top, your monthly bill more than triples. And that's before we even add in what happens to your drug coverage under Part D, which we'll get to in a moment. And here's what makes this so sneaky. This isn't a one-time fee you pay and move on from. It's your new monthly premium for an entire year, based on a decision you made 2 years ago that you've probably already forgotten about. Maybe it was selling an investment or a bigger withdrawal than usual. At the time, it felt completely unrelated to your health insurance. No warning, no red flag. Then one day, a letter arrives from Social Security, and your monthly Medicare bill suddenly looks nothing like what you budgeted for, with no way to undo whatever caused it. Let's say you sell your home in 2024. That money doesn't affect your health insurance in 2024. It doesn't affect it in 2025. It shows up as a surprise in your mailbox in 2026, sometimes over a year after you've already spent or invested that money. By the time the letter arrives, the decision is already made. You can't undo the home sale. You can't undo the Roth conversion. And here's something most people don't know. There's a rule called hold harmless that's supposed to protect your Social Security check from shrinking because of a Medicare premium increase. But that protection does not apply once you're paying IRMAA. There's no safety net cushioning this blow. His happens most often around one specific moment: the sale of a family home. A home you may have owned for 20, 30 years. One that quietly tripled or quadrupled in value while you weren't paying attention to its price. Maybe you bought it young, raised a family in it, paid it off slowly over decades. You never thought of it as an investment, just home. But the market didn't know that. And when you finally sell, all of that quiet growth becomes taxable income, all in one single year. That's the moment most retirees never see coming, and it's exactly the moment we're going to break down next. Doesn't apply to me. Fair, but even a modest Roth conversion or a single big withdrawal can trigger this. So let's talk about the 5 most common ways people walk right into this trap, and what you can actually do about it. In my experience, it almost always comes down to one of 5 situations: selling your home, a Roth conversion, required minimum distributions after age 73, a one-time event like a business sale, or the year Social Security and RMDs start together. Here's how big this can get. Say you bought a home in 1994 for $175,000. By 2024, that same home is worth around $789,000, a profit of $614,000. Add a modest retirement income of $68,100, and your total income for that 1 year jumps past $682,000. If you're single, that puts you in the top IRMAA tier. Your Part B premium jumps from $202.90 to $689.90 a month. Nearly $7,000 more a year, just from selling a house you already owned. A Roth conversion can be one of the smartest tax moves you make for the long run. It can lower your future required withdrawals and give you more control over your tax bill in retirement. But here's the catch. If you don't check what that conversion does 2 years down the road, it can quietly set off this exact same trap. The amount you convert counts as income the year you do it, and that income is exactly what Medicare will be looking at 2 years later when it decides what you owe. So before you convert a large amount in any single year, it's worth running the numbers first. If you've already been hit with an IRMAA notice, here's what most people don't know. there's an official appeal process. Social Security will recalculate your premium using your current income instead of the 2-year-old number, but only if you match one of a specific list of life-changing events: death of a spouse, marriage or divorce, you or your spouse stopping work or reducing hours. This is the big one because retirement itself counts. Loss of income-producing property due to a disaster, loss of a pension, or filing an amended tax return showing lower income. The form you need is called SSA 44. But one important note: simply selling your house for a profit on its own usually does not qualify, because that's not a life-changing event. That's just a high-income year. The form takes maybe 20 minutes to fill out, but almost nobody does it, simply because almost nobody knows it exists. Social Security isn't going to call you and offer this. There's no reminder on your premium notice telling you that an appeal is even possible. You have to know to ask for it, and you have to know which life-changing event applies to your situation. So if you've been hit with a higher premium and one of those situations sounds like you, it's worth the 20 minutes. The worst outcome is they say no. The best outcome is your bill drops back down. 2026 that almost nobody's covering yet, and it might actually work in your favor. It has to do with how your taxable income is calculated this year. Let's take a quick look at it because it could change where you actually land on that chart we just showed you. Here's something brand new for 2026 that most Medicare videos aren't covering yet. New tax law changes, including a new senior deduction, and adjustments to how certain business income is treated, are changing what actually counts toward your taxable income this year. That means some retirees who were used to sitting comfortably under the IRMAA line may find the math has shifted for 2026 and 2027. This isn't a reason to panic, it's a reason to double-check. If you're within 2 years of retiring, selling property, or doing a Roth conversion, it's worth checking where you actually land under this year's rules, not the ones you remember from a few years ago. Tax rules shift every year, quietly, in the background. Most people only notice when the bill lands in their mailbox. A deduction that didn't exist last year might exist this year. A threshold that used to catch you might now sit just above your income. None of this gets announced with fanfare. It just quietly updates in the fine print of the tax code, which is exactly why it's worth checking now, before that bill arrives, rather than finding out after the fact. So here's what to actually do. First, if you're selling a primary home, remember the exclusion. Up to $250,000 of profit is tax-free if you're single, $500,000 if you're married, as long as you've owned and lived in the home for 2 of the last 5 years. Second, if you're planning a Roth conversion, do the math 2 years ahead, not just for this year. And third, watch the year your Social Security and RMDs start overlapping. That's usually the year IRMAA shows up for the first time. To recap, IRMAA looks 2 years back, it works like a cliff, and it's most often triggered by a home sale, a Roth conversion, RMDs, or Social Security and RMDs starting together. If it happens to you, an appeal using Form SSA 44 may bring it back down. None of this has to catch you off guard. A little planning 2 years ahead of time is often all it takes to keep your retirement exactly as comfortable as you've earned it to be. You've spent decades building this. A few minutes of checking a bracket, timing a conversion, or filling out one simple form is a small price to pay to protect it. That's really what this whole video comes down to. Not fear, just a little bit of foresight. If you want to protect your wealth and stop overpaying the government, download your free retirement roadmap below. Don't forget to like this video, subscribe for more advanced wealth strategies, and I will see you in the next episode.